Welcome back, champions. Another mind-boggling stock news. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. Technical analysis tools are used to scrutinize the ways supply and demand for a security will affect changes in price, volume, and implied volatility. It operates from the assumption that past trading activity and price changes of a security can be valuable indicators of the security's future price movements when paired with appropriate investing or trading rules. Technical analysis as we know it today was first introduced by Charles Dow and the Dow theory in the late 1800s. Several noteworthy researchers including William P. Hamilton, Robert Rhea, Edson Gould, and John McGee further contributed to Dow theory concepts helping to form its basis. Nowadays, technical analysis has evolved to include hundreds of patterns and signals developed through years of research. In general, technical analysts look at the following broad types of indicators. They are price trends, chart patterns, volume and momentum indicators, oscillators, moving averages, support and resistance levels, etc. 7 of the best indicators for day trading are: Number 1. On-balance volume, OBV. Use the on-balance volume to measure the positive and negative flow of volume in a security over time. The indicator is a running total of up volume minus down volume. Up volume is how much volume there is on a day when the price rallies. Down volume is the volume on a day when the price falls. Each day volume is added or subtracted from the indicator based on whether the price went higher or lower. When OBV rises, it shows that buyers will step in and push the price higher. When OBV falls, the selling volume outpaces the buying volume, which indicates lower prices. In this way, it acts like a trend confirmation tool. If price and OBV are rising, that helps indicate a continuation of the trend. Number 2. Accumulation/distribution, A/D, line. One of the most commonly used indicators to determine the money flow in and out of a security is the accumulation/distribution line. Similar to OBV, this indicator also accounts for the trading range for the period and where the close is in relation to that range in addition to the closing price of the security for the period. If a stock finishes near its high, the indicator gives volume more weight than if it closes near the midpoint of its range. The different calculations mean that OBV will work better in some cases and A/D will work better in others. Traders using the A/D line also watch for divergence. If the A/D starts falling while the price rises, this signals that the trend is in trouble and could reverse. Similarly, if the price trends lower and A/D starts rising, that could signal higher prices to come. Number 3. Average directional index. The average directional index is a trend indicator used to measure the strength and momentum of a trend. When the ADX is above 40, the trend is considered to have a lot of directional strength, either up or down, depending on the direction the price is moving. When the ADX indicator is below 20, the trend is considered to be weak or non-trending. Number 4. Arun oscillator. The Arun oscillator is a technical indicator used to measure whether a security is in a trend, and more specifically if the price is hitting new highs or lows over the calculation period, typically 25. The indicator can also be used to identify when a new trend is set to begin. The Arun indicator comprises 2 lines, an Arun up line and an Arun down line. When the Arun up crosses above the Arun down, that is the first sign of a possible trend change. If the Arun up hits 100 and stays relatively close to that level while the Arun down stays near 0, that is positive confirmation of an uptrend. The reverse is also true. If Arun down crosses above Arun up and stays near 100, this indicates that the downtrend is in force. Number 5. Moving average convergence divergence, MACD. The moving average convergence divergence indicator helps traders see the trend direction, as well as the momentum of that trend. It also provides a number of trade signals. When the MACD is above 0, the price is in an upward phase. If the MACD is below 0, it has entered a bearish period. The indicator is composed of 2 lines, the MACD line and a signal line, which moves slower. When MACD crosses below the signal line, it indicates that the price is falling. When the MACD line crosses above the signal line, the price is rising. Number 6. Relative Strength Index, RSI. The relative strength index has at least three major uses. The indicator moves between 0 and 100, plotting recent price gains versus recent price losses. The RSI levels therefore help in gauging momentum and trend strength. Number 7. Stochastic oscillator. The stochastic oscillator measures the current price relative to the price range over a number of periods. Plotted between 0 and 100, the idea is that the price should make new highs when the trend is up. In a downtrend, the price tends to make new lows. The stochastic tracks whether this is happening. Professional technical analysts typically accept three general assumptions for the discipline. The first is that, similar to the efficient market hypothesis, the market discounts everything. Second, they expect that prices, even in random market movements, will exhibit trends regardless of the time frame being observed. Finally, they believe that history tends to repeat itself. The repetitive nature of price movements is often attributed to market psychology, which tends to be very predictable based on emotions like fear or excitement. Did you find the information helpful? Let us know in the comments.